Well, it was the event that was billed as Liberation Day, but do you feel liberated? Certainly markets are rippling at the moment. We're seeing higher volatility in NASDAQ futures. We're seeing Trump really bringing the tariff game to China, Japan, a lot of the Asian emerging market nations as well. And uncertainty still perpetuates through markets. There's a lot more to explore. A lot of questions being asked by the markets that are not going to be immediately answered, certainly around inflation, economics, consumption, and all these factors. And that uncertainty should continue to breed volatility through markets. And that's what we look at in today's trade-off. We look at the trade in gold, US equities, the dollar, volatility more broadly. It's on today. This is the trade-off. Well, g'day, I'm Chris Weston, Head of Research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the inner sanctums that are going on in financial markets, this rapidly developing and evolving news flow that's really perpetuating through markets. As I say, there's a lot of questions being asked right now. People are trying to understand what this means in the short term, medium term, longer term, all these factors that we try and price risk efficiently, both from market risk and also from economics, earnings risk, and all these various factors. And we're in the cloud of the eye of the storm at the moment, where that uncertainty continues to manifest. So I'm going to bring in a man who hopefully brings us a bit more clarity, and I'm sure he will, because he does always do that, and that's Mr. Blake Morrow coming to the show, sir. Well, it was billed as Liberation Day. I think it was only really liberation for Americans, so it doesn't really include me. But do you feel liberated, Blake?
I think the markets are unshackled. How about that?
Well, I feel liberated because we're getting a bit of vol back into markets, and we've had a bit of volatility in equity futures and equity markets for a little bit of time now. But it's really been the US dollar that's been shackled, and we can talk about that in a bit more depth. But I'm seeing signs now that perhaps the US dollar may see some higher volatility playing through, which would be great for us FX traders. And we'll have to see. There's been a lot of consolidation going into this, but maybe that's now released. I think the Chinese currency is the really one you want to watch. So it's on, and I think we need to talk about the future and how we trade that. So let's go into topical thunder and explore exactly what's going on. Well, they called it Liberation Day, Trump's term, and obviously this is what we've seen right on the close, just after the close of the cash markets, US equity cash markets, and into the futures trade, was billed as one of the most anticipated fiscal moments for the US for some time. And I think, there's another question I want to pose to you, Blake. But I mean, the tariff rates that have been set. We know that there's a sort of a universal base of 10% across the board. That's going to kick in on the 5th of April, and then there's going to be certain nations who obviously have run more structural higher deficits with the US who are getting significant, reciprocal tariff increases. So China's obviously the one that everyone's focused on. That's an extra 34 percentage points of tariff. So this year that takes them to 57% or so. And I think their effective tariff rate sits about 60% or above that level now. Japan, an extra 24% in this run. Europe, 20%. You've got countries like Vietnam at 46% in this tariff run. These are big, punchy numbers. And those higher numbers are going to come through on the 9th of April. This really looks like it's going to be a non-negotiable situation. We did hear from one White House official saying, this is not a negotiation. This is a national emergency. Pretty hard-hitting words, which suggests that those tariff rates are set in place, and maybe there's some wriggle room as well. But it really depends now on some certain nations how they respond. But I think obviously what this is going to have an impact on earnings. It's going to have an impact on expectations of inflation and growth. So break it down, Blake. Have you there's two things, right? First one, have we learned enough to give us a bit more clarity relative to expectations on the tariff news in itself? And have we learned enough now to sort of price risk and growth in the future?
Yes and yes. So I guess the first question is, did he meet expectations, or did we meet expectations? We obviously know now that, as you just pointed out, we're coming at the world hard and hot and heavy. And let me say this just from an American's point of view. Look, it's we are just citizens of the world, and we have to kind of, we're dealing with this just as you guys are in one way, shape, or form. So I just want to, say that. Now, as far as like, did he come at the rest of the world very hard? He did. And I think the market was not prepared for that. I think the market, you could see the market was bid up today, thinking that that now, we're going to get some sort of back and forth. And as you pointed out, there's not going to be any negotiations. That I don't think the market expected. And now can we price risk appropriately? I think in certain assets, you look at like Canada and Mexico, they skirted a little bit with everything staying at 25%. They're going to renegotiate USMCA. That's probably going to hit on some topics. That should be overall, Canadian and Mexican peso positive. But in this risk environment, it's hard to say. You saw how futures responded. We broke last week's lows or 2 weeks lows in the S&P. And I think the market is currently repricing everything. Now, I guess the question I'm going to have, and we can move it into the next topic and just talk about the markets in general, Chris, is, these markets, they have responded. Like I said, we see futures down right now, and they're down and they're staying down. That's one thing. The other thing that you'll notice is the dollar is actually weaker against certain currencies. And you said, there's probably going to be some USD vol coming in the market, which is good for us. That is good. What do you mean by vol? Because the question I have in my mind right now, and you're going to see some charts too a little bit later that are going to reaffirm what I'm about ready to say. But the question that I have now is, when is the dollar going to really come under pressure? Because people believe, and they've believed that tariffs are going to bring in more revenues. It's going to be positive for the dollar. I think you're going to see the dollar and U.S. assets, which you're seeing right now, you're going to see them more shunned. So the question, I'm going to throw it to you, and I know I've been speaking a lot, but we transitioned from one topic to another, is how do you feel about the markets where they sit, and how do you feel about the dollar? I'm very bearish the dollar at this point.
Yeah, I think I come back to my question, and that is that I think we've learned as much as we were going to learn from today. We know the tariff rates. We know if they're relative to expectations and your base case formula. We know the starting dates, the implementation dates. They're more aggressive. They're pretty much instant. And we've got a pretty good idea about how people are going to respond, and that's the next point to it. So I think we learned a lot from this event, or as much as we were hoping to do. Now what we need to do is project those rates into economics. What's going to be the fallout? Higher inflation expectations, the demand for US products, and those various factors as well. And I think from that perspective, the US dollar's a really hard one, because raising $700 billion or so and reducing the deficit over that is obviously a dollar positive. The fact that we're seeing the Fed constrained by what they're seeing at the moment is a US dollar positive in some capacities. But where this falls out is what's happening in the bond market, because the bond market now is telling us that they're not worried about inflation so much. They're worried about the growth downside. And I think that is a negative for the US dollar at a time when, we've got a big fiscal plan in China. Remember that they're offsetting what they're seeing here. One looks like the currency. I think it's going to be higher for the vol in the currency, but also they've got a fiscal program, a fiscal stimulus, about 8% of GDP, which still needs to be rolled out. And in Germany, we've got their whatever it takes moment as well, which is a fiscal moment, and that is a positive for the euro. So that offsets what we've been seeing there. So it's difficult to do, but I think the US dollar has downside, because now people are saying that you've got this toxic backdrop of higher inflation expectations, at least short term. 1 and 2 year inflation swaps are ballooning up at the moment. You've got lower growth. We're going to see that in the jobs numbers. Jobs numbers have got downside, and you're going to see that a hit to US earnings and margins as well, because of what we've been seeing here. So it's very difficult to buy the dollar based on this. And I think you've really got to look at the reaction in the front end of the bond market, because if yields go down, it's telling you there's a growth problem, the recession risk's increasing, or if not, stagflation risk's increasing, and that's a dollar negative, despite what we're seeing in tariffs, which are going to impact China in a big way, Europe in a big way. But what these countries are doing now is, we saw that in Europe last night, is that they said that they're creating a fiscal stimulus package to offset this. They're doing defense, whatever it takes moments, and China are also offsetting that. I think the biggest issue for the US dollar now is how we model growth, how far this can go, and what are the stagflationary risks if there are, if it's not overblown. And the front end of the bond market and parts of the shape of the yield curve, I think will tell you what you need to do with the dollar on the back of this. But it's going to be a hard one for them to stop. I think it's difficult. Also, the other fact is, Blake, you sell me Blake's beer internationally. I'm an Australian or a Canadian. Sell me Blake's beer. I'm not buying that anymore. I'm not buying that. American beer doesn't taste nice anyway. But there's going to be a whole protectionism issue here.
It's it.
It begins with a P. But yeah, I mean, look, you're already seeing Canadians just shop. And look, I'm sympathetic of reciprocal tariffs. I'm very reciprocal. I'm open-minded. They're bringing it up to where other nations are. Other nations should bring theirs down. I'm fully on board with that. And I'm very sympathetic to the American argument in that. I don't know if they're necessarily selling it. But what's more important, though, is how these other countries respond from a consumer perspective. There's going to be a massive protectionist issue. There's going to be a huge don't buy America from here.
As you pointed, you were just alluding to, you see it in Canada. I was just in Mexico literally last week, and you see it when people they talk about it.
Canadian purchase of American beer, it has just dropped off a cliff. Travel numbers from Canadians going to America, forward booking orders have dropped off a cliff. I mean, that's just one country, but that's right, because there's been a lot of spice between Trump and Trudeau, but it's now going to be. I mean, it's obviously in Europe, less so in obviously China's going to be there as well. I mean, these people, they're going to be sold that this tariff's very much unjust. There's going to be a lot of don't buy America. That's not me being anti-American. I'm not that at all. I'm very reciprocal to the idea of them lifting up tariffs to at the same level of other people. I'm not against that, but I think there will be.
It's going to be part of it, and that's the thing that we, like, as I said initially. Look, I'm American. I have to deal with this in a different way than people in other countries. But yeah, I just have to say this just because I have a friend that went to Canada, and the hate speech that he got at a bar with other people at the bar in Toronto, I believe, was he was pretty floored by people's sentiment towards him as an American, being an American, just sitting there trying to be a guy,
But I think the average American who would have watched Trump, who unless they're a Democrat supporter, but if you're and the average American who's right leaning would probably have watched that last night and said, you know what, we've been unfairly treated by the world. Trump's right to do this, and he's probably galvanized his base.
He probably has, and there are going to be repercussions, as you're pointing out.
Absolutely. And that's what we're trying to model, right? That's what we're trying to model.
Exactly, and that's why I believe the dollar is to be sold. And I think
let's get on, because I'm getting waved.
Okay, let's talk about the dollar.
Because it does feed nicely into the dollar, because that's what we've been talking about. So we've just probably answered half the stuff in that situation. But I look at this right now, and you can go and put a 24% extra tariff on Japan, and there had been signs that the Japanese and Trump and his team were getting on quite well, but a 24% tariff is certainly not as bad as what we've been seeing in some of the other Asian countries, but the Japanese won't like that at all. So the yen, that does take a hit, but what we're seeing now is yen inflows, and dollar yen is coming under pressure. US Treasury futures are moving very, very hard, and the yen in times of high volatility will do quite well in this situation. You talked about Mexico and Canada, and they've had a bit of a reprieve because of what we're doing. I think Brazil looks interesting because the Brazilians have already come out this morning and saying that actually on their tariff rate of 10% that they're fairly happy with what they've been seeing there as well. And while they've got a political issue in Brazil that is negative for the currency and grows concerns, they've got arguably the highest real rates of any country that you want to be involved with. The carry there is great if you've still got low vol. And they're a central bank that's still putting up rates. So you've got that clear central buy. So I love the Brazilian. There are times where the Brazilian real looks great. But for me now, what happens is for me, the central focus here is twofold. One, euro dollar, you've got to look at that. That's been in consolidation mode. I think we hadn't seen an up or down daily percentage move of over 0.5% in 15 trading sessions prior to today. People haven't really wanted to do too much. But dollar CNH, the offshore yuan, or the yuan, is going to be the most important one for me now, Blake, because you've got a 60% tariff. So that's 20% plus what was already there, plus the extra 34%. That is going to hurt. So what do they do with that? They've got the fiscal measures. What do they do with their currency now? That's going to be watched by currency traders. And if the dollar rallies against the Chinese currency, well, and they believe that there's going to be a sustained depreciation. That's got to be negative for the Aussie. It's got to be negative for the China proxies. And so that's the one I'm watching, and also how the PBOC treat that in their daily fix. How are you doing it?
Yeah, so I'm going to ask you a couple questions. First of all, as far as China's response, and you have to realize, well, everybody here realizes, I'm sure, China's economy has been sluggish, although we've seen their markets respond to all these fiscal measures they've done. But imagine them like the Wizard of Oz, and behind the scenes, they just pull that lever, they're pulling a lever and they're going to weaken that currency, and that's a lever that they're going to use, in my opinion, and as you point out, that stronger dollar China. And so if that happens, that's that risk aversion that you might actually see, and you're going to see those China proxies, as you point out with the Aussie. So my question to you, being a Westerner and an American, and you follow the Asian markets very closely and what the PBOC does, what's the time frame that we should be looking at as traders to look at what China's response is going to be? Because they're seeing it right now. They just got up and they're like, oh my God.
Yeah. Well, they've been, despite the 20% extra 20 percentage point tariffs that have been additioned this year, the response from them has been, quite sympathetic and actually, hasn't been particularly hard hit. It's been very targeted to certain sectors. And it's been quite measured in a relative capacity. Now, does that change? I don't think that will. And we'll probably hear some commentary through today from Chinese officials saying that these tariffs are unjustified and blah, blah, blah. But the response so far has been pretty measured. And we'd probably expect to see that coming through. And look, if they are going to go for a sustained depreciation of the yuan like we saw in 2018, then they're certainly not going to tell people that they want to do that. I mean, we're going to see that in the tolerance in the daily fixing mechanisms, which comes through at 12:15 my time, Australia's time, every single day. They move the midpoint of the US dollar or the CNY, the onshore currency, up or down as per their basket. And that will tell us a lot about the semantics, whether they're really willing to tolerate that. And I think that will be something we're watching. But the moves that we've seen in the dollar CNH, which is the one you can speculate that's traded out in Hong Kong, since the reopen this morning, everyone's buying, everyone's selling the yuan, everyone's expecting a response. Now, what we see over time is when the yuan is stable and very, very tight ranges, we see lower volatility in G10 FX markets, euro dollar, Aussie dollar, cable, for example. But when it rips and you see range expansion, it starts to trend and the speculators are pushing CNH against CNY, that's when we get higher volatility in G10 FX markets. And I'm hoping that's the case. I think that really puts the Chinese currency right at the center. It doesn't get traded a lot because spreads are a little bit more expensive and various factors. But I think at times like this, the response through the currency channels could have huge implications. But let's not forget, Blake, as well. Sorry, I'm going on a bit here, but they can't let people on shore have a strong belief of that we're going to see a sustained weakness, because households, high net worth individuals, businesses, if you get a positive expectancy that we're going to see a sustained devaluation 5-10%, they want to get their money out of the country. It creates capital outflows, which creates a tightening of financial conditions, which is negative for growth. They can't install that belief, and they'll obviously throw that conjecture that that there's not going to be a sustained. We won't know that there's going to be a sustained rally until it actually happens, or it's happened. You know what I mean? So that's really important that they don't plant the seed that this is going to be sustained, because people want to get their money out of China. Obviously, they've got capital controls, but if we do that capital flight, when they need that money in China to create the demand from the fiscal, I think that's a really important balancing act for them to get right. Hey, crypto. Hey, Bitcoin. Well, it comes back to gold. Right. Chinese are all buying gold at the moment. You've seen there's a Chinese ETF and the inflows from households, retail investors. It's all going into gold at the moment. Sure is. All right. Well, I don't think that's going to stop. It doesn't seem like. Okay. Last topic. Let's talk about the jobs report. It's the other elephant in the room, and this tariff, these tariff announcements and Liberation Day couldn't happen at a more interesting time for the U.S. economy, and I could almost argue maybe the global economy, as we are seeing, things slow down around the world, and everybody's curious to know when the jobs report is going to start showing signs of weakness. I see a lot of economists have moved their estimates down towards 100,000 and some below.
And so we're going to be in for a heck of a Friday this week with the jobs report. And this, everything that just happened today is going to spice up a little bit about how I'm going to approach the NFP. So you're looking at, I just want to say, if the data is weak, dollar yen, you pointed out, I think yen's a great risk proxy. Weak data, stock's going to get hit, stock market's going to hit. But I like the sterling right now. You notice sterling's stable and UK is stable at 10% tariff. Reciprocal tariff rate. And so therefore sterling's trading at its highest levels and trying to break out as we're filming right now. Now, if the data is strong, what do? Do you sell? Like for me, I'm looking at the Aussie dollar thinking, and if it's strong data, I'm going to sell the Aussie dollar and buy dollars. And maybe we get that response from China, maybe even the Kiwi. Yeah. How are you going to play the jobs report come Friday? Because now we got a few other, floating pieces that we got to pay attention to.
I think you've got to look at the most obvious or the most sensitive trade or the clearest trade. And obviously it's always going to be the rates market and the front end of the bond curve to the non-farm payrolls. The payrolls, as we know, is a really hard one to trade because you've got to, we've got the ISM services number coming up, in the session ahead for us. And, we're looking at prices paid versus new exports that feeds into the inflation or stagflation narrative. But you've got headline level of job creation. I think the market's looking for 135,000. If it comes in, certainly if it comes in below 100,000, that's a psychological. I think that would cause risk to come off. You've got the unemployment rate, you've got average hourly earnings, you've got revisions, you've got underemployment numbers. There's a whole multitude. The market will choose what it wants to look at. But yeah, I think if the market takes it that this is a disappointing jobs number, 100,000 unemployment rate ticks up to 4.1, 4.2%. Average hourly earnings were to increase. If that was to happen, then it feeds the stagflation. And then I think, the clearest reaction, obviously, if you want to go and buy treasuries, you'd probably see a move there. 10-year would come down, low end of the range. But yeah, I think right now, sell what's moving. And that would just be go and sell NASDAQ, go and sell the NASDAQ and NASDAQ futures, whatever you want to do. The dollar's an interesting one because it's just not clear cut. Dollar yen would come down. That would be the obvious reaction for me. It'd be dollar yen in the effects situation. But yeah, I think, again, it comes down to this idea, Blake. If we got a good number, like the market likes what they're hearing, or we get a bad number, think about what that looks like. For me, from a reaction function perspective, I would argue strongly that risk assets, crypto, equities, have more downside to a poor number than the potential upside to a good number in this situation, just because of where we are. We're exploring how growth can low, how poor can growth be. We're exploring stagflation risk. That to me is the reaction function, is that we get a bigger response and a more emphatic sell-off than we would do should we get a good number and risk rally. Do you agree or disagree with that?
I agree with that. And actually, I'd be more in tune of selling a risk rally. So in other words,
I'd sell rallies. I think that's the trade. Yeah, but
good data, get the euro back at 108. I'd be a buyer.
Well, I think in the art of managing risk, for me, it's. And you make a great point. I think I'm probably just articulating what you're saying, reading between the tea leaves here, is that for me, stay out of the non-farm payrolls number because it could go either way, obviously, and you're trading all these different variables. Depending on what it looks like, you get a spike in risk, NASDAQ, S&P, sell into it. I think that's the trade.
There you go.
The market's giving you a gift, so to speak. Anyway, let's go to the setups.
I love your playbook.
Let's go to the setups and matters. Let's go to that's the setup. Right, that was a bit of a long session, sorry, but obviously a lot going on, and we could have been there for another hour. But anyway, let's bring up the charts because a lot of what we just said can now be seen in the technicals. And actually, since I pushed this chart into the system, actually the market's lower from this point. But what we've seen is that continuation pattern playing through the wedge, the bear flag, whatever you want to call it, and also then we've taken out those lows on a closing basis. So the downside on this technical target is obviously significantly lower from where we are at the moment. We're holding the 5-day exponential moving average. Rallies are being sold into that level. And I guess we had gone into this with the market thinking, we wanted to reduce positioning. We wanted to run a flat position because, it could go either way. We could see a market-friendly response, which was something Trump was positioning or pushing for us, or we could get something that causes or perpetuates the concern around growth going forward. And clearly, I think we've got the latter. And I think for this perspective, the point I've got to be asking myself is, why would you be buying risk right now? We're back at a continuation. The uncertainty hasn't given us any answers at all. We've got this big data flow this week, which, again, could be better. It could be worse. If it is worse, then equities have got further to fall. We're going into earnings season. Earnings revisions have been coming lower. And, a 10% base tariff with a bit more across the board, equates to something like an earnings per share decline of about, revision down about 5 to 6% of EPS. So, the question is, why would you buy with that uncertainty? It's aggressive. People are going to be buying those, trying to pick the lows. Of course, people try and do that. But for the guys who are controlling the big money in the market, the investors, with this uncertainty and the fact that markets are in free fall at the moment, because you can't price that certainty around those factors, why would you buy? And that's that buyer's strike will see the market lower, in my opinion.
And that chart is a beautiful bear flag for those of you that haven't picked that one out from Chris. So, and you have to ask the question. I think it's a great question. Why would you buy it right now? Hey, my first setup is going to be the 10-year yields. And, Treasury Secretary Bessent has been very vocal about, their desires to bring yields down. And I think that this chart pattern is going to give you that. You see 10-year breakdown. The reciprocal move would be US dollar weakness in this situation. This is a chart that's been circulating around for a long time, but we've actually been looking at this chart for the last few weeks, even setting up that right shoulder. But notice how yields couldn't even get past the 38% retracement. That is what we call a shallow bounce, which means it is a continuation pattern typically. So in my opinion, looking at 10-year yields, and I'm just going to pull up the price on my screen. I mean, it looks like, if everything works the way it should, we'll probably be closer down to 350 over time. That's not going to happen anytime in the near future, but that would be the trajectory of yields, which means that the dollar yen, more specifically, would suffer as a result. So keep your eye on the 10-year yields. Keep your eye on the neckline that's right here. The ZNs, the 10-year notes, they look exactly opposite, obviously, with the neckline on an inverted head and shoulder pattern. So there you go.
Cool. I'm just trying to get an update on where the gold price is at the moment, because
gold is at 31.56.
Oh yeah, so it's higher. So yeah, let's have a look at the chart of gold, because since I pushed this out, we're a bit higher now. So that was done about sort of 7 o'clock this morning. But yeah, 31.56. So we've taken another leg up. I thought there was a chance that we get consolidation, but yeah, that was before what we've seen in the response that's come through specifically in Asia. Specifically in Asia, the move that we saw over the announcements was a bit whippy, and then the market sort of Asia's come in this morning, and we're seeing a risk off picture. That's a new development. So yeah, we're trading new all-time highs now, and what we specifically fundamentally we liked about gold was that it was working as a hedge. Up until Friday, treasuries weren't working as a hedge because people were seeing inflation risk. Now people are more focused on growth. That inflation treasuries are starting to work a little bit better as a hedge. You've got the central bank buying. We're all seeing inflows into the Chinese gold ETF. I can't remember the name now, but I'll put it out in the comments section. But huge inflows into the Chinese gold ETF. And that is thematic of retail and households buying gold now in China in a big way. And I think, that gives it extra tailwind. So you've got a hedge that's been working. Equities go down again. You're not really too sure what to do with the dollar in this situation. Probably sell it, but against select currencies, real rates are going to go lower. Treasury yields are lower. Again, is this the next leg up in the gold market? It feels like it might be.
Yeah, it might be. And this is maybe the acceleration phase of a blow off top in gold. So, and look, if we do have a blow off top, Chris, it's just one thing you don't want to get in front of. And this looks like that kind of move. Anyway, my last setup is going to be the Aussie yen. And unfortunately, the Aussie yen has dropped about another percent since I put this chart on the screen. We are, we're currently trading at 92.70, and I'm looking at a nice solid downtrend as the 88% retracement comes in at 91.56. That's the level that I think everybody should watch, because that's where those recent lows back in early March were at. And a break below there, it's going to target the lows. Now, I did say but, and the reason why I say but is because we, as Chris has been aptly pointing out here over the course of the last few, 10, 15 minutes, is we do have to keep an eye on China and watch their response. And I've been whipped around enough in the markets to know that even as good as trends look as they do right now, doesn't mean they're going to persist. So I will keep an eye on that trend line. That comes in where the 50 DMA is. And as long as we stay below that red trend line, we stay below that 50 DMA, I think that's your mark for further lows. Question is, if we get back above that, do you see a big reversal? My answer would be we might. So you just have to be a little bit careful. And I think you know where your risk is in this situation. Yeah,
well, those charts are moving around pretty violently at the moment. So good for the vol, not for everyone. We'll have to see how it goes. Trade it as per your strategy and your risk approach. Anyway, let's go to play of the day. Well, I'll tell you what, if I could have bought gold at the price I just showed you there, I would have done it. That would have been a free trade. But obviously that's not the case. Oh yeah, dollar yen for me is the one. So yeah, again, for all those reasons I talked about, we've got similar to what we've been seeing, a similar structure as what we're seeing in the NASDAQ. We've got this continuation pattern, this bear flag in play. We've broken that to the downside. There's some hesitations around the yen given the new tariff rates, but it's thematic of everywhere. And I think if we were to see the VIX above 25%, and equity markets going into further drawdown, then we'd probably look at the Japanese yen as probably the best safe haven in G10FX. And there's concerns around the US dollar. Obviously, tariffs is a revenue raiser that addresses the deficit, but it impacts growth, and that's what we're trying to model. How far can growth be? The hard data has been okay in the US. The soft data, as we've heard from various Fed members, is collapsing at the moment. And you've got the prices paid subcomponents of the regional PMIs, the ISM, moving up at record space, huge differentials now to new export orders. So the question is what happens to labour markets? And again, it comes down to this idea that the market wants a response from the Fed. They always go to the Fed for a circuit breaker in times like this, and when growth's being called into question, when equity volatility is going out. But we've still got a Fed who are still this Titanic that needs to move around, and they're not yet. And until we actually get a more dovish reaction from the Fed, which they're constrained by trying to model inflation, then their downside risk the US dollar. The market needs to see a response from the Fed. They're pricing in more rate cuts, which is pushing it down. But until we can get a point where the Fed come to meet the markets, that when we've got that separation, that will keep the volatility in the markets higher, and I think dollar yen going lower.
All right, and it does not look bullish. How about that?
It looks orange.
If I was a bull, I'd not be happy right now.
Keep it kidneys.
And let's talk. And here, I'll give you one for hope for you dollar bulls. My play of the day is going to be the dollar MEX. I happen to be short it right now, and I'm positive.
Quick fact. Sorry to take up some of your time.
Go ahead.
It's National Burrito Day. So
hey,
there you go.
I think I might celebrate tonight. Actually.
Anyway, so going back to dollar MEX pattern.
All right, so we have a nice harmonic pattern. More importantly, as a rejection over at the 618, you can see the slump below 20.28. That happened after the tariff announcement, and with USMCA happening, that's giving the Mexican peso and the Canadian dollar a little bit of a shove here. And I know this is not normal to risk aversion. You see the Mexican peso actually strengthen, but if risk does get supported, or you start to see, some, I think Mexico, you guys know this, Mexico and I think the US are going to be working closer together than most other countries. I know I've expressed this idea over, the last several months. Whether it's, electric vehicles, from Chinese-made electric vehicles to immigration, to fentanyl, to drugs, to cartels, you name it. So I think the dollar Mexican peso, it's giving you that level to be on the short side. I'm actually looking for it to eventually slip below 20. And as dust settles and the markets regain its footing, I think we're going to go to new trend lows. So the dollar Mexican peso is my play of the day to the short side for different reasons of selling the dollar, though.
Good stuff. Good stuff. All right, Blake, thank you very much indeed. For everyone who's stuck around watching, we really appreciate it. Obviously, a lot going on in financial markets. This time at the end of the week, we could be 3-4% higher. We could be another 4% lower in risk. We'll have to see how the data flows and how the market continues to trade what's been going on around tariffs, because this is one of the biggest fiscal moments that we've seen in the US for many, many years. They're talking 1930s. I'm not sure if that's hyperbole, but hyperbole, whatever you want to call it. But certainly one of the biggest moments for the US for quite some time. The markets are responding now. So we'll see what happens. Obviously, in this situation, focus on your risk, focus on your position size relative to the account, and also the volatility in the market, and stay in the game as long as you can. Hopefully that's some words of wisdom. Anyway, thank you very much. Leave your comments in the field below. Smash the like button. We'll see you back next week.